Hi there, hello everyone. As part of my fundamental analysis series, I'm going to discuss very important topic. What is the relationship between interest rates and the forex market? So let's dive into it. So it's a strong correlation between interest rates and forex trading, and money attempts to follow the currency with the highest real interest rate. And forex traders must keep an eye on each country's central bank interest rate policy, and more importantly, when it is going to take a step that it's going to change something, then it has a definite impact on currencies, and then currencies actually move with the increase or decrease in the interest rate. So this is how we look at this table. When the market is forecasting something and the actual rate comes in the market, what is the impact on forex market? So when the market is forecasting rate increase and the actual rate holds, then the currency depreciates. And when the market is forecasting rate cut and the actual rate holds, then the forex market the currency appreciates. And in the same way, when the market is expecting or forecasting that the rate will hold and the actual rate actually hikes or gets increased, then the currency will appreciate in this case, and then vice versa. In the case of if the market is forecasting that the rate will hold and actual rate is cut, then the currency will depreciate in the forex market. Okay, so central banks have two main tasks. Number one, to manage inflation, and number two, stability of currency. They do this by changing interest rates and managing the nation's money policy. And when inflation is ticking upwards above the central bank's target, they will increase the central bank rate using the policy tools, which can restrict the economy and bring inflation back in check. So this is how they balance the economy, by increasing the interest rate. And economies are either expanding or contracting. When economies are expanding, everyone is better off, and when economies are contracting or in kind of a recession, they are worse off. And the central bank aims to keep inflation in check while allowing the economy to grow at a modest pace, all by managing the interest rate. So this is very important tool of managing the interest rate. So let's look at two scenarios: expanding economy where GDP growth is positive, and in a contracting economy where GDP growth is negative. So what happens in an expanding economy? Consumers earn more. Okay, there's more money and then more spending. So more money, fewer goods, and then it triggers inflation. And then where central bank comes in, it increases interest rates, and it reduces, the result is that it reduces spending and inflation. So this is how it happens. When the economy is booming and expanding, then it also triggers inflation, and to control inflation, central bank introduce higher interest rates, and then it reduces spending and inflation and then bring into balance. So what happens in a contracting economy where GDP growth becomes negative? So it's deflation, maybe, meaning negative inflation. That's a problem as well. And then central banks lower interest rates, as opposed to expanding economy where central banks increase interest rate. So when they lower interest rate, it boosts spending and investment. Companies get loan at low interest rates and companies invest in projects. As a result, what happens? It increases employment growth and ultimately inflation. Okay, decreases inflation. Okay, all right, so what happens? Let's look at this cycle. Central bank lowers interest rate. As a result, economy expands and inflation increases. Now inflation has increased. Now the central bank has to balance this. So what they do, central bank increase interest rate. So what happens with the increase in interest rate? Then economy contracts, and then again the central bank lowers the interest rate. So this is how the cycle keeps goes on and on. So for a trader to forecast central bank rates, they must keep a close eye on what the central banks are currently monitoring. Central banks monitor economic indicators, and the central banks decide to increase or decrease interest rates based on several economic data points. Okay, and forex traders can follow an economic calendar to keep track of the data releases. Inflation, unemployment, and the exchange rate are some of the major data points. And the trader must be in tune with the central bank policymakers and almost try to forecast what their action will be before making it public. And this matter of trading is based on the fundamentals, which is different to trading using technical analysis. Okay, so let's look at two scenarios. What happens when interest rate increases, so inflation decreases and currency value increases and we buy that currency. Okay, on the other hand, when interest rate decreases, inflation increases and currency value decreases and we sell that currency. So in both these scenarios, as a forex trader, we will buy here, buy that currency here, and then in this scenario and in this scenario we will sell that currency. So this is how forex traders have to look at the interest rate and the forex market relationship, and then they can develop their strategies accordingly. So for forex traders, it is very important to understand different central banks interest rates policies and how the markets are moving or will move based on the changes, increase or decrease in the interest rates of that particular country. Alright guys, I will stop here. I hope you like the video. I will see you next time. Have a good day. Bye bye.